Hi everyone, this is Ted Bauman, editor of the Bauman Letter here at Banyan Hill Publishing. Well, Christmas is almost here, and investors want to know what Santa's going to be bringing. And for a long time, people have been saying, maybe there's going to be a recession in 2020, which would count as a lump of coal rather than the present, of course. I don't see that happening. In fact, I think a lot of people who predicted recession next year have revised their views based on some significant recent events. And I'd like to start today's video by reviewing those. They're going to lead to a surprising conclusion, one that you probably wouldn't necessarily expect given what's been happening. So what has been happening? First thing, the US and China have reached a trade deal, right? They call it a phase one deal. Essentially what it does is it takes us back more or less to where we were before the trade war started. But let's forget about that and just focus on the fact that it means that US businesses are no longer going to have the uncertainty of a Chinese tariff war basically holding back their investments. So that's one good thing. Second good thing, Congress has agreed a new continental trade deal with Mexico and Canada. It's going to be called the USCMA. Basically it is going to replace NAFTA. And again, this is a nice bonus for business people and investors who've been worried about the uncertainty of not knowing where our trade relations with our neighbors are going to be. Then in Britain, Boris Johnson's Conservative Party won in a blowout, which means that Brexit is definitely going to be happening. And that means that that uncertainty has been lifted, although, as you'll see, there are some other issues to be addressed still. Finally, the Federal Reserve has made it clear that it's not going to raise interest rates next year. They've basically said, look, we've reassessed the relationship between unemployment and inflation. We don't see inflationary threats, so there's no need for us to raise interest rates, which means that investors are happy. So with all of that going on, you would think, well, let's just do what we want. Let's just buy. In fact, a guy named Chris Rupke, who is the financial economist at MUFG Union Bank, basically said that. He said, back up your truck and buy. There's no risk. Bet on it, buy it, just take it all. Now, that's obviously crazy advice, and I don't think he really meant it quite that way. We still need to be selective. We still need to look for good stocks within a generally positive outlook. But I think there are actually three reasons why we should be looking outside the United States, outside of Europe and China for our gains, some biggest gains starting next year. First of all, let's talk about what's happening or what's likely to happen next year in the United States. First of all, the lifting of the trade threat, the threat of a trade war with China, means that businesses that haven't been investing very much in the last few years are going to start doing it again. And when they do, that's going to reduce their profit margins and put downward pressure on their share price. And that's one reason why the big investment houses like Goldman Sachs and JP Morgan and others have all basically said, we don't see big growth in the stock market overall, probably less than 10% in 2020, simply because all of these companies that have been holding back will now start investing again, and that will put downward pressure on stocks, at least temporarily. The second issue is that in Europe, although we know that there's going to be a Brexit, it's going to take at least a year or maybe two for Britain to renegotiate all of its many relationships with the EU. All the things that were covered under the EU agreement now have to be renegotiated one by one, and that's going to take time. Britain is also going to have to negotiate new relationships with every other country on the world or in the world that it trades with. So there's still going to be some uncertainty in Britain. In China, I think the key issue there is that the government is wanting to rein in excessive debt. They allowed debt to build up over the last couple of years as a kind of a countermeasure or hedge against the potential downward pressure on the growth caused by the trade war. Well, now that the trade war has been basically removed as an issue, the Chinese will continue to try to rein in debt, and that will probably hold things back to a certain extent in the Chinese economy. We'll see growth in their export sectors, but the domestic sectors and things like housing and real estate investment, all those things are likely to have a kind of a tepid year. So what that means to me is that although we have all this cloud lifted off of the markets, we can expect no recession. We're probably not going to see huge growth in the major advanced economies. However, I do see growth coming in from another direction. And to understand that, I want to show you a chart. Now, this chart shows the Standard & Poor's 500 in the blue area. And then in the red, what you're looking at is an emerging market basket of companies. It's basically all those emerging market economies like South Africa, like India, etc. Many different parts of the world. Also in Southeast Asia, especially where big manufacturing support for Chinese economy happens. Now, take a close look at the period between the beginning of 2016 and the beginning of 2018. And what you see there is a fairly rapid upward growth in emerging markets. Now, in fact, that basket of companies that's represented by this red line grew by 75% during those 3 years, right? That's a very significant growth. In fact, it grew faster than the Standard & Poor's 500, which only grew by 45% during those years. Now, if you were to extrapolate that line, if you were to just kind of like look at it, its slope, and then draw it up to the y-axis, it would probably cross at about 75%, but it doesn't. At the beginning of 2018, you see that emerging markets began to decline, and they've been trading more or less sideways ever since. And the simple reason for that was that it was at the beginning of 2018 that the US-China trade conflict began in earnest. Now, a lot of the companies that are represented in that red line basket of companies are companies that supply things to China, whether they be raw materials like iron ore or various other raw materials like that, or components. Countries like Vietnam and Thailand who supply components to the Chinese. All these countries have continued to do reasonably well, but the problem is that investors have been worried about the consequences of the US-China trade war on their exports to China. And as a result, they've steered away from buying these equities, right? Which is why you see this line, this red line, just kind of dawdling sideways up until today. Now, the lesson that I draw from this is that now that we've removed the trade war from the equation, I expect that emerging market stocks are going to resume the growth path that they were on up to the beginning of 2018. And as you can see, there's a crazy divergence in valuation between emerging market economies and companies and the US stock market. And smart investors are going to say, well, we need to buy into places where companies are cheap, where equities are cheap. That means emerging markets. And that's going to put up their prices, right? So I expect that we're going to see a takeoff in emerging markets in 2020 and into 2021 if the trade war issue holds, right? Now, I've said earlier in previous videos and other places that I expect next year to be tough on the US stock market also because of the election. Simply the uncertainty of knowing who is going to be the president after January 2021. Same thing will happen that happened in 2016. We'll see some reluctance to invest in the US stock market. That means that the money is going to be looking for profit elsewhere, and I think it's going to be in emerging markets. So the key thing for me is that there's a big gap that's opened up between emerging market valuations that was really undeserved. I mean, those countries and the companies in those indexes didn't deserve to be so undervalued. It was a knock-on effect from the trade war. Now that the trade war is over, and because I see slowdowns in the major economies, logically, we're going to see good gains potential from emerging markets. So my recommendation for you, my last recommendation of the year, in fact, is the iShares MSCI Emerging Markets ETF, or EEM. Now that's an ETF. You can buy it and trade it just like any stock. I've held it before myself, and I think it's a great way to play the emerging market gains that we're going to see. Now, there are a couple of other possibilities, I think, other individual companies that are going to do well, even in the U.S. market, especially in the U.S. market, because of cyclical factors the resurgence of semiconductors, 5G, new autonomous vehicles. So all that's going to keep happening. My basic thesis today is simply that there's a big value play in emerging markets. And this is one place that you can put money very easily and safely and play that and probably beat the US market by significant percentages during the next year or so. So that's my message for today. And by the way, if you're not a subscriber, look at the text below this video. You'll see a link that will take you to my Bauman newsletter, where I make investment recommendations. Those kind of companies that are going to beat the market in the US especially. So have a look. You may like what you see. I'd welcome you as a subscriber to the Bauman Letter. This is Ted Bauman signing off. I will be speaking to you again soon. Take care.